My name is Jeff Bershon. I'm an associate in the securities practice group at Shaheen, Novoselsky, Stat, Filipowski, and Eccleston, along with my co-presenters today, April Lindauer and Ron Amato. Many of the items I will discuss may not directly affect your business in that you do not offer these products. However, some of your clients may be solicited by others to purchase these offerings, or promoters may contact you directly about selling their investment opportunities. Oil, gas investment funds. The high price of oil means that oil and gas scams will continue to attract victims. These deals generally require significant investment and are highly complicated. These deals are high risk, but the lure of big profits due to the high price of oil can prove irresistible to investors. Investors need to be cautious when they are offered, quote, can't-miss deals. Opportunities include leases in oil fields to unproven technologies designed to convert common substances into fuel, or investments in oil wells that do not exist. Prime bank. This scheme often promises significant returns as a result from both offshore trading of bank debentures or leasing of U.S. Treasury bonds. Investors are told that the trading was only offered to very wealthy individuals, but that the promoter is able to make this opportunity available to regular investors. State and SEC enforcement actions reveal these actions as Ponzi schemes. Clients are also told that they will need to sign a confidentiality agreement in order that they cannot discuss this investment. This is normally a red flag. Affinity fraud. Members of closely knit religious, political, or ethnic groups are told that based upon their common beliefs or background, they should consider investing with that group. Investors should be wary of these emotional appeals. Promissory notes. Normally, these opportunities promise high returns and are offered as an alternative to more traditional investments, guarantee above-market returns, fixed interest rates, while safeguarding principles. Investors need to verify whether these promissory notes are registered and whether the person offering them is also registered to sell securities. Promissory notes that are marketed broadly to the general public often turn out to be scams. Penny stock fraud. Unethical brokers or promoters frequently pump up the price of a thinly traded, low-priced security and dump the stock after naive investors have purchased the stock at inflated prices. Some of you have seen the stacks or email blasting touting the stock of the day. However, if you look at the fine print, you normally see that the promoter owns a large percentage of the stock at normally a reduced value. Unregistered products. Similar to promissory notes discussed above, products such as sales and lease-back programs for paid telephones or ATM machines, or viatical settlements, where investors pool their money to invest in insurance proceeds, have been determined to be securities under state securities law and federal securities law. This requires registration, which affords investors proper protection. Investors need to be cautious of these promises made by these promoters. Private placements. Normally, these investments are offered to high net worth investors who are sophisticated, have experience investing in these sort of risky startup endeavors. These private placements are normally sold pursuant to an exemption, and investors are required to declare whether they are accredited investors. Normally, the exemption relied upon under the federal securities law indicates that there cannot be a general solicitation of a private placement. Senior investments. April will discuss the suitability aspects of variable annuities and index equity annuities. Many seniors are targeted for seminars and sold investments irrespective of whether they are suitable for that individual. While people 60 and older make up 15% of the U.S. population, they account for almost one-third of the fraud victims. Personal information scam. The key is separating a victim from their money is to convince them to divulge personal financial information. Investors need to be particularly aware of requests from telemarketers or from the Internet asking for personal financial information, such as social security numbers, bank account numbers, credit card numbers, etc. Sales practice violations. Just as every individual investor is unique, so too are investment securities professionals, and they must know and understand their client's financial situation and risk tolerance. NASD Rule 2310 and New York Stock Exchange Rule 405 address the suitability considerations an investment professional must evaluate prior to the sale of a security to the investing public and their specific investors. This time I would like to turn the presentation to April Lindau.